Hi, good evening, everyone. Welcome to UOB Hyung CIO series number 29. Today, we're going to talk about what worked in 2025, what's possibly coming up next, and a sneak preview to 2026. Let me start with our year beginning predictions for 2025. I'm not sure you guys remember, we've been talking about this since December 2024 about our 5 bold predictions for this year. And we've been right on 4 out of the 5 so far. We correctly predicted the rebound in the Chinese economy and markets, that Chinese GDP did indeed beat expectations in the first half and third quarter, even though real estate continued to struggle. Number 2, on US-China relations, we said that things could temporarily improve, and that was indeed the case for the bulk of 2025. Until recently, US-China relations were relatively peaceful until the rare earth incident, and the market almost forgot about it at one point. So we also nailed that. We said that large cap US stocks may underperform in 2025 because of the high valuation and extreme outperformance in recent years. That unfortunately did not happen this year. As you know, Nvidia just crossed $5 trillion in market cap recently, and Magnificent Seven continue to outperform the rest of S&P 500. Number 4, we said there will be some extreme price volatility this year, and watch out for some systematic risk. Indeed, we have seen volatility spikes in crypto, in gold recently, and of course, equities has been a roller coaster ride this year. And most unexpectedly is the volatility in US dollar, which we shared with you since May 2025 about de-dollarization as a long-term trend. And lastly, on AI, we remain bullish, maintain a high conviction, and we've been saying that edge AI and AI applications will take center stage. It indeed grabbed all the attention and continue to proliferate in 2025, not just the data center, not just GPUs, not just the back end, but edge AI and AI applications. Just to remind you all, we have been consistently constructive on China, despite the volatility. And here's my CNBC interview from February this year, when the market was extremely pessimistic about tariffs and Trump being reelected and all these risks weighing down the China market. But we've been right, and we've been consistent. Okay, as promised, let's look at 2026 now. It's not too early. We only got about 2 months left of the year. And before I share my outlook, I want to talk to you about 2 things. One is, I'm sure someone's going to ask, what is your year-end 2026 price target for Hang Seng Index, for example? And as you know, I tend to avoid those questions. I almost never give price targets, even if for gold, which I have very long-term conviction in. And the reason is this: today's markets work very differently now. They're constantly and rapidly changing. And within the markets, there are also a lot of structural changes that is not necessarily captured by the market index. And there's another practical issue. I just give you one example here. If you look at a Hang Seng Index in the chart below, let's say you correctly predicted against all odds at the beginning of this year that Hang Seng is going to reach 26,000 at the end of 2025, at early 2020. When you make that prediction earlier this year, what will happen? First of all, you're right, but the market almost reached 26,000, remember, in somewhere around March 2025. Then what you do? 3 months of the year, your target is almost reached. You sell, or you lift the target to 28,000. Most people will trade a momentum when it reaches 26,000, they think it's going to go to 28,000. So again, most people will probably be bullish at that time, but the market crashed. And when the market crashed almost to below 20,000, would you still have conviction in your 26,000 price target? Is that still a meaningful price target? It's easier said, yes, but in reality, it's not easy. Okay? People forgot how panicked the market was when the video was even trading below $100 a share. Now it's almost $200. So not easy. And then now let's look at now. Now it's over 26. It breached 26,000 at one point. Right? Now what? What do we do? What next? It's not like the index of 26,000, we wash our hands and we can go home and sell all stocks and job done. The investment is a constant game. It's a perpetual game. You still have to look forward to the next thing, the next year. So I don't think the fixed point target is that helpful. It's good to know sometimes, but it doesn't really help our investment decision. What we need to have is a directional bias. If you can have a directional view, at least a directional bias. And then the other thing I want to talk about is what if we are wrong? We've been wrong. I already showed you we've been wrong 1 out of our 5 predictions this year. We've been wrong on US equity being too conservative. We're wrong on global equity. What do we do when you're wrong? That's called risk management. And that is more important than taking views, because every view we take, we already assume that we could be wrong, and we're going to do something to make sure that we're prepared for those situations where we are wrong. So here's a simple math can show you that you could be wrong more than 50% of the time and still make money because you could manage your risk properly. If you minimize your loss when you're wrong and try to maximize your wins when you're right, you can still make money even if you could be 60% wrong, right? So that is the math. And also it's easier said than done, but that is the truth. So risk management is very important. So with those two things in mind, no fixed price target for 2026. Number 2 is let's prepare that we are wrong. Let's talk about the 3 disruptive forces for the next year and even the next decade. And you've seen this before because we've been talking about this all through 2025. Nothing changed. Not much has changed. I don't think not much will change in 2026. The 3 most important factors: US-China relations, de-dollarization, and AI. The reason to put this circular arrow in the center is to show you these 3 things are actually interrelated. Now let's take those 3 things and give an outlook for 2026. For US-China relations, I expect things to get worse, not better. I expect to have some thunderstorms or even some super typhoons in US-China relations in 2026 because of the midterm elections coming up, because of US and China continue to engage each other in these strategic competition, or in some cases, trade war or tariff wars. That's not going to change. That's not going to end. Even though we have the news today that there may be some truce, but we all been there before. They said we have truce, then suddenly one side decided to impose new restrictions. Exactly what happened a month ago. Long term, also do not expect things get better. This is a divorce between the US and China. It's not a simple couples fighting. What do? If we cannot take a view on which side will win, why don't we bet on both horses? Because US and China are uniquely different, inherently different. They offer different opportunity sets, and why don't we just invest in both? So you need to invest in both US and China because the outcome of this competition is unclear, and they also offer very different opportunities, which I'll talk in a second. De-dollarization is not going to change, and it will continue for next year and for the next 10 years. It's a long-term secular trend. On AI, we are seeing some cloud gathering in the near term. This is not the stock price speaking. If you look at the stock market, the market telling you all things are fine. But not all things are fine. Long term, we're still bullish. We still have high conviction. Just next year, prepare some small headwinds, possibly some hiccups. Positioning for 2026. I talk about the 3 forces that are going to drive the market in 2026. The US-China relations, AI and de-dollarization. How should we position 2026? This is a very preliminary conclusion. In the US, we will stay invested in AI and the defensives. I just talked about the defensive as an important hedge against AI, or even just a hedge overall for geopolitical risks or for all kinds of unforeseen risks. We also like energy, continue to like energy as a hedge against geopolitical risks, and also beneficiaries of the increasing demand from data centers and AI. Energy is a great play for those type of applications. In China, you also need to have both, right? So AI plus defensive, that's always a good combination. That's our barbell strategy. Let me say this another time. The barbell strategy dictate both our US and China investment strategy. For China, we also like something called the tourism, Macau gaming stocks, and Trip.com. And Trip.com is interesting because it's actually both a tourism play and an AI play. I can talk more about that if you're interested. Potential new themes in 2026. And this is also what we missed in 2025. I said earlier that we cannot be right on everything. We cannot make all the money off the table. We've been right on certain things. We'll make decent money this year in our model portfolio, but we also missed a great number of things. One of the things we missed is nuclear energy and related materials. That's something we will go deeper into 2026 as soon as possible. So please follow us. Please ask us questions in the future when we launch our report or core recommendations there. I think there's some really interesting names and ETFs we can look at. Aerospace and defense. That's a geopolitical risk trade, maybe related to Donald Trump, maybe just related to overall shifts about how things are changing globally between countries. But there's also one caveat here, which is the success of Chinese EV makers are now driving European car makers to this business. That is one business, the defense industry, that could not possibly outsource to China, could not possibly import everything from China. So that's a national security matter. That's an economic matter because European and Japanese companies need this business to counter the loss from competing with Chinese industrial companies. So that is a booming industry for several reasons. Europe will continue to invest in these areas and continue to subsidize. Gold mining, I mentioned earlier, is something we missed this year. And I think it's interesting because it has attributes of both gold as a commodity and as equity. I mentioned earlier that we've been overly cautious on equity, so we missed the equity rally. So perhaps if we are wrong again on equities being too cautious, we can use gold mining equity stocks as a way to catch up at both angles. And lastly, on the new China consumption, it's a very interesting story now that overall consumption in China is not changing much. In fact, the latest numbers, the China's consumption has entered the lowest month in September, 3% growth only, the slowest month year to date and the slowest month in almost 12 months. Okay, but if you look underneath the 3% growth, there are a lot of interesting secular structural changes within Chinese consumption, like online, like gold jewelry, like things have emotional value, attachment to it. Not necessarily practical things, but things like toys or tourism. That's another consumption theme that we've been sharing with you and making core recommendation about that fits under the new China consumption. And if you look at Chinese GDP today, it is still predominantly driven by domestic consumption. So that's a very important matter. We'll continue to find new ideas and new themes for you in the near future. Just to remind you how important this US-China relations are in understanding the markets and finding opportunities and protecting yourselves in terms of your investments. Thanks again, everyone, for participating, and I look forward to talking to you for the next CIO series.